Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Invoice Finance is a flexible, practical way for businesses to boost their cash flow and manage outstanding invoices more effectively. By utilizing invoice factoring or invoice discounting, companies can access funds tied up in unpaid invoices, ensuring a steady stream of cash to meet operational expenses and support growth. This financial solution caters to a wide range of businesses, particularly small and medium-sized enterprises, SMEs, operating in a business-to-business, B2B, environment. Understanding Invoice Finance. Invoice Finance is a financial tool designed to help businesses maintain a healthy cash flow by quickly providing access to funds from their unpaid invoices. It allows you to unlock a percentage of the value of your outstanding invoices, sometimes within 24 hours, giving you the means to cover expenses and invest in your business's growth. In essence, the lender uses your unpaid invoices as security for funding, offering a cash advance based on its risk criteria. This type of funding can be particularly useful for businesses that experience gaps in cash flow due to slow-paying clients, or seasonal fluctuations in revenue. There are two main types of invoice financing: invoice factoring and invoice discounting. Invoice factoring involves selling your invoices to the lender, who takes over credit control and collects payments directly from your customers. This option can be attractive if you prefer to outsource your credit management processes, or do not have the resources to manage them effectively. On the other hand, invoice discounting allows you to maintain control over collecting payments from customers, while still receiving a cash advance from the lender. This is ideal for businesses that prefer to maintain direct relationships with their clients and have established credit management practices. Both types of invoice finance can be a useful source of financing for companies that need immediate access to cash, but do not want to wait for their outstanding invoices to be paid. It's important, however, to carefully assess the costs and potential risks associated with invoice finance, as well as your business's eligibility before pursuing this funding option. In doing so, you can confidently leverage it as an effective means to support your business's growth and cash flow management needs. Types of invoice finance. In the world of business financing, invoice finance is a popular option that allows you to access funds tied up in unpaid invoices. There are several types of invoice finance you can choose from, depending on your specific needs and preferences. In this section, we will explore three main types: invoice factoring, invoice discounting, and selective invoice finance. Invoice factoring is a financing option where you sell your unpaid invoices to a finance provider. The provider then lends you up to 90% of the value of your invoices and takes over the responsibility of managing your sales ledger, collecting payment for your invoices directly from your customers. This option is ideal for businesses that want to outsource their credit control and collections. Invoice discounting is another form of invoice finance. In this case, you sell your unpaid invoices to a third party, but unlike invoice factoring, you retain control over credit control and collections. The finance provider will pay you a percentage of the value of your invoices upfront, usually up to 90%. This option is suitable for businesses that want to maintain control over customer relationships while benefiting